In the current cycle, Wall Street traders are closely watching every economic data release and every word from Fed officials, trying to pick up on subtle signals of a policy shift. Although the Fed lowered its federal funds rate target range to 3.50%, 3.75% in December 2025, expectations for further rate cuts in 2026 have steadily cooled. According to the latest CME FedWatch tool data, traders now expect only 2 rate cuts in 2026, with the first possibly delayed until June, a pullback from the 3 cuts priced in at the end of 2025. This shift in expectations reflects a mix of factors at play. December 2025, retail sales came in lukewarm, but the market's real focus is on the upcoming revision to the January 2026 non-farm payrolls report. Although the original February 7th release was delayed to February 12th due to the government shutdown, a New York Fed report has already offered a hint. U.S. household loan delinquencies rose to 4.8% in Q4 2025, the highest since 2017. So far, the increase among lower-income borrowers hasn't triggered systemic risk. At the same time, sticky inflation has dented confidence in a quick return to target. The December CPI showed a year-over-year dip, but services and shelter costs remain elevated. In a February 9th speech, Fed Vice Chair Philip Jefferson stated bluntly that rates are now near the neutral range, leaving little urgency to cut. Growing fiscal pressure has added another layer of complexity to the Fed's decision-making. U.S. debt has ballooned by $696 billion in just 4 months, pushing the total past 100% of GDP. Interest costs have now crossed the $1 trillion threshold. Goldman Sachs analysts warn that fiscal sustainability concerns could force the Fed to keep rates high to attract buyers, a dynamic that has clearly dampened expectations for rate cuts. The market reaction was quick and sharp. On February 10th, the Dow hit another record high, lifted by financials, but the S&P 500 and Nasdaq slipped on weak retail data and fears that AI is disrupting the finance industry. Tech stocks showed a clear split. AI leaders like NVIDIA and Microsoft were supported by their long-term CAPEX plans, while traditional financial names like Goldman Sachs and JPMorgan fell on pressure from net interest income. In bond markets, the 10-year Treasury yield hovered around 4.25%, weighing further on richly valued growth stocks. The Fed's policy stance is shifting from data-dependent to risk-balancing. While a cooling labor market and falling inflation provide theoretical room for rate cuts, fiscal deficits and debt sustainability concerns have become critical constraints on monetary easing. For U.S. equities, this means 2 scenarios to watch. One is a hawkish pause. If January payrolls come in unexpectedly strong, the Fed could shelve rate cuts entirely, putting valuation pressure on stocks. The other is a fiscal-driven cut. If debt service costs trigger market stress, the Fed might be forced to cut to stabilize bonds, but that risks unanchoring inflation expectations. Given this policy backdrop, investors should reduce their bets on a soft landing and focus on the Q4 2025 GDP revision and February CPI data, both due in March, for signals of a policy pivot. On positioning, it makes sense to increase exposure to defensive sectors like energy and healthcare, while staying cautious on high-valuation tech names to avoid concentration risk.